Imagine getting decades of hard-won wisdom from one of the most successful business minds out there, all distilled into plain, accessible language. That's kind of the journey we're taking today.
Absolutely. Our source material is the Essays of Warren Buffett, Lessons for Corporate America, and it's a fantastic collection. Lawrence Cunningham selected and arranged them.
Right.
These aren't just random thoughts. They're pulled straight from Buffett's shareholder letters. From his time as chairman and CEO of Berkshire Hathaway, covering decades of experience.
So it really is like getting a curated masterclass. Straight from the source, Buffett in his own words, covering, well, everything. Fundamental value analysis, how to run a company, finance, accounting, even tricky stuff like mergers and acquisitions.
Precisely. Cunningham did a great job pulling together the essays that really boiled down Buffett's core principles. And a lot of these, they offer a surprisingly simple yet really powerful alternative to the conventional business wisdom you often hear.
Okay, so our mission in this deep dive is basically to unpack the most important insights from this collection for you. Give you a shortcut, maybe, to understanding what really matters according to, well, the Oracle of Omaha, getting those timeless lessons.
Sounds good.
Yeah.
Let's maybe start right at the foundation, Buffett's whole philosophy. It's really rooted in treating shareholders, not just as, temporary visitors, but as genuine partners, as owners of the business.
Yeah, the owner mentality. That's not just a feel-good idea, is it?
Yeah.
It's practical. Comes from those value analysis principles from Ben Graham and David Dodd.
Exactly.
It means managers see themselves as stewards of the capital the owners entrusted to them.
And you see this reflected in Berkshire's shareholder base. It's
Yeah.
quite unique. They're known for being really loyal, very long-term focused. The essays mention, I think, that consistently something like 98% of shares are held by people who were already shareholders at the start of the year.
Wow, 98%.
Yeah, that kind of retention is, well, it's incredibly rare. It helps build a true owner community.
So how does that owner focus actually change things day to day, like how they communicate?
But it shifts the whole focus. Communication isn't about managing Wall Street's expectations for the next quarter's stock price,
Right.
It's about talking to your partner candidly, clearly, regularly.
Yeah.
Berkshire really prioritizes substance over spin. They put out that detailed annual report, talk directly about business fundamentals, share the bad news right alongside the good.
No PR fluff then.
No reliance on PR consultants or, trying to cater to whatever the market's feeling that day. It's direct.
So their reporting isn't really driven by that quarterly earnings pressure.
Exactly. They consciously avoid that. The focus is just relentlessly long-term. And their specific long-term goal reflects this owner view perfectly.
Yeah.
Maximizing the average annual rate of gain in intrinsic business value per share.
Intrinsic value.
Yeah, over the long term. It's about making the economic pie bigger for each owner, measured by real business progress, not just, how big the company gets overall.
That's a really powerful guiding principle. How does that owner-based approach then influence who they pick to actually, run the businesses inside Berkshire?
Oh, it's paramount. When you look at governance and management in the essays, Buffett really hammers home finding able, honest, and hardworking people. That's almost everything.
And boards?
For boards, he likes them small. Mostly outside directors who have real business savvy and, crucially, that same owner orientation.
I bet he has some strong opinions on typical corporate boards then.
Oh, definitely. He's pretty critical of how often, friendly relationships on a board can kind of overshadow their actual duty to the shareholder.
Right, the congeniality factor.
Exactly. He points out how hard it is to objectively evaluate the CEO if everyone's too close. And he notes, interestingly, that sometimes a director's strongest weapon is just being willing to resign if there's a major disagreement on something critical.
That must lead to some incredibly tough decisions in practice. Is there an example in the essays?
Yeah, classic one is the decision way back to close Berkshire's original textile plant in New England in the 80s. The business had been struggling economically for years. It was a really tough call. Buffett discusses the huge social impact, on the community, the employees who'd been there forever.
So how does he square the tension between, the hard economic reality and the social impact from that owner perspective?
He acknowledges how difficult and painful it was, no question.
Yeah.
But looking purely at maximizing long-term intrinsic value for the owners, the decision, while incredibly hard, was ultimately necessary. Economically rational, it just highlights that really tough balancing act management faces sometimes.
Right.
prioritizing the long-term health of the whole enterprise for the owners, but still respecting the human cost involved.
And they even get shareholders involved directly in things like corporate charity. That seems really unusual.
It is pretty unique. Berkshire has this program where shareholders can actually designate which charities get a piece of Berkshire's corporate donations. It's a direct way of involving the owners in capital allocation, which is so different from the usual models where management just decides. It really reinforces the idea that ultimately it's the owner's money.
Speaking of money and allocation, what about executive pay? That's always a hot topic.
Oh yeah, it's a major focus in the essays. Buffett has a really strong critique of stock options, especially as the main way executives get paid.
Why is that?
Well, he argues they don't accurately reflect the true cost to the company when they're granted. They can seriously dilute existing shareholders. And, critically, they aren't necessarily tied to actually increasing the underlying intrinsic value of a business.
How so?
Well, the stock price can go up just because the whole market is rising, right?
Yeah.
So executives can get rewarded even if their specific business performance wasn't great. He calls it rewarding the sluggard, I think.
Okay, so what does he prefer then? How do they try to align manager incentives with what the owners want?
He much prefers incentive compensation that's tied directly to specific, measurable business results, things that demonstrably increase intrinsic value over time. There's an example in the essays about H.H. Brown Shoe Company.
Right.
Their management pay was structured specifically to reward increasing the company's intrinsic value per share. So management gets paid for making the owners richer in terms of the business's actual economic power. Makes sense.
Yeah, it does. Okay, so we've looked at the foundation, how it shapes running the business.
Yeah.
How does this owner mentality carry over when Buffett and his team are deciding where to invest or what businesses to buy?
Ah, well, that leads us straight into his investment philosophy, famously illustrated by the Mr. Market allegory.
Mr. Market, right? He's the sort of emotional business partner who shows up every day.
Exactly that. Your hypothetical partner in any stock you own, described as manic depressive. Every single day, Mr. Market turns up, offers you a price, either to buy your share or sell you his. And his price is totally based on his mood that day, swinging wildly from, crazy optimism to deep pessimism.
So what's the smart investor supposed to do with Mr. Market?
The key insight, the lesson, is basically to ignore Mr. Market's moods. Ignore his daily price quotes most of the time. The intelligent investor should focus only on the intrinsic value of the actual business they own a piece of.
Only engage when the price is right.
Precisely. You only pay attention to Mr. Market when he offers you a price that's significantly below that intrinsic value. That's when you might buy more. Or maybe if he offers a price significantly above it, you might consider selling. His daily price is just an option to transact, not some call to command.
This feels like it directly challenges a lot of standard finance ideas, doesn't it? Like the efficient market hypothesis, or using beta for risk.
Oh, absolutely. Buffett fundamentally believes markets are far from perfectly efficient. All that human emotion, irrationality, short-term thinking, it creates mispriced opportunities that a value investor can potentially exploit.
And
Yeah, he strongly critiques using beta, that measure of how much a stock price bounces around relative to the market, as the definition of risk. To Buffett, real risk isn't volatility. Real risk is the chance of permanent loss of capital.
And where does that permanent loss usually come from, in his view? Paying too much.
Paying too much is a big one, or misunderstanding the business you're buying, or using too much debt. Basically, risk comes from not knowing what you're doing, not from the temporary price swings Mr. Market throws at you.
He also says something interesting, that value investing is redundant. What's that about?
Yeah. He means that all intelligent investing is value investing. It's simply the process of figuring out what a business is truly worth its intrinsic value based on future prospects, and then only buying a piece of it when the market price gives you a nice discount, a margin of safety below that value.
And the opposite is speculation.
Exactly. Speculation is just buying something hoping the price goes up without really understanding the underlying business economics. Value investing is buying a piece of a business you understand.
And this focus on intrinsic value, the long haul, it means Berkshire doesn't do a lot of trading.
Absolutely not. The essays talk about the bane of trading. Constantly buying and selling just racks up huge transaction costs, taxes. It eats away at your returns over time.
So the strategy is buy and hold.
Berkshire's strategy is long-term ownership. Find fundamentally good businesses, buy them at sensible prices, and then ideally you want to hold them pretty much forever.
And I heard they even structure the company like the shares themselves, to attract a certain kind of investor.
Yes, that's definitely part of the deliberate strategy. Things like avoiding stock splits, which tend to encourage more short-term trading and keeping that Class A share price very high. It's all designed to attract and keep shareholders who think like owners, who are in it for the long term, and maybe deter the short-term speculators just playing price wiggles.
Can you give us an example from the essays where this whole approach was really tested?
Hmm. A notable one is Berkshire's experience with U.S. Air preferred stock. Back in the late 80s, early 90s, the airline industry turned out to be way tougher economically than maybe they first thought.
Airlines.
Yeah. Buffett talks about the hard lessons learned there, about the fundamental economics, super capital intensive, labor issues, brutal competition.
So what did they do when the investment got into trouble? When the value dropped a lot, did they sell?
Well, this is where that owner mentality really shows. Even though the market price tanked, Berkshire didn't panic sell. They analyzed the situation, still believed in the long-term, the difficult prospects of the underlying asset, and they held on. It showed patience, rooted in understanding the business, not just reacting to Mr. Market's despair.
Right. And similarly, wasn't there something with RJR Nabisco junk bonds that also highlighted needing deep analysis?
Exactly. The term junk bond, it's just a label. It's based on credit ratings. Buffett stresses that investing successfully there requires really painstaking credit analysis.
Understanding the actual business behind the bond?
Precisely. Understanding the specific company, its ability to generate cash, its debt structure, the real risks involved. It wasn't about just blindly chasing high yields. It was doing the hard work to figure out the odds of getting your principal and interest back based on the actual business economics.
So whether it's stocks or bonds, it always comes back to really understanding the business itself. And this careful analysis, I assume, extends to how Berkshire grows, particularly through acquisitions.
Oh, definitely. Acquisitions are a huge part of how Berkshire grows, but the essays actually spend a lot of time explaining why most acquisitions in general fail to create value for the buyer's shareholders.
Why is that? Bad motives, paying too much.
Both. Buffett points to common bad motives like, managerial ego wanting a bigger empire, or just the thrill of the chase, or making wildly optimistic projections about synergies that just never happen. And yes, often paying way too high a price.
So what makes for a sound acquisition in Berkshire's book? What are they looking for?
They look for businesses with really excellent, durable economic characteristics, like a good moat, combined with able and honest management already in place, people they trust to keep running it well. And, crucially, they need a sensible price, based on intrinsic value.
What about using Berkshire stock to pay? Is that common?
Buffett is extremely cautious about that, especially if Berkshire's own stock seems to be trading below its intrinsic value at the time.
Why?
Well, think about it. Issuing your own undervalued stock to buy another business, which might itself be overpriced. He calls that a double whammy. It massively destroys value for your existing shareholders. He much prefers using cash if possible, or only using stock if Berkshire's stock itself is trading at or maybe even above its intrinsic value.
Okay, so in contrast to maybe value-destroying moves like that, he sees sensible stock repurchases as a good thing.
Yes, very much so. Buying back Berkshire shares when you're trading below their intrinsic value, that's seen as a really effective way to use capital. You're essentially buying more of your own great business for the remaining owners at a discount. He contrasts that sharply with things like, say, Greenmail, which he sees as terrible for shareholders.
And flipping it around, for business owners who might be thinking of selling, what makes selling to Berkshire appealing from their side?
Buffett really emphasizes offering a permanent, trustworthy home for the business. Owners who sell to Berkshire generally know their company isn't just going to be flipped quickly or broken up or have its culture totally changed for some financial engineering reason.
Stability and trust.
Yeah, they value that cultural fit, the assurance that the business and its people will likely be treated well for the long run. It's why Berkshire often prefers buying entire businesses directly from owner-managers, rather than getting into big auctions.
Okay, this is great. We've covered a lot on strategy, management, investing. But another huge theme running through these essays is the need to look beyond standard accounting numbers, to understand the real economics of a business.
Yes, this is absolutely critical. Buffett is famously critical of accounting methods that can sometimes hide the true economic picture, or even be manipulated. There's a great satirical piece he includes about U.S. Steel, just illustrating how accounting rules can let companies inflate reported earnings.
So the message is accountants report, but investors need to evaluate.
Exactly. Investors and managers have to understand the underlying economic engine, not just the reported numbers.
So how do you get a truer picture then? What tools does he suggest?
Well, one key concept he introduced is look-through earnings. This is especially important for a holding company like Berkshire.
How does that work?
You take Berkshire's standard reported GAAP earnings, and then you add the undistributed earnings of all the companies Berkshire owns a big chunk of, but maybe not enough to fully consolidate in the accounts.
Ah, the earnings they kept but didn't pay out as dividends.
Right. Adding those back gives you a much more complete view of the total earning power that Berkshire's owners effectively have a claim on across all their businesses.
He also makes a really important distinction, doesn't he, between economic goodwill and accounting goodwill. Sounds a bit technical, but it seems key.
It's fundamental to his thinking. Economic goodwill.
Yeah.
That's the real stuff. It's the enduring value of a business that lets it earn super high returns on the actual capital invested. Things like brand recognition, customer loyalty, a strong competitive advantage, the economic moat.
And accounting goodwill.
Accounting goodwill is, well, it's just an artifact. It gets created on the balance sheet when one company buys another for more than the fair value of its identifiable net assets. It's an accounting plug, basically.
And standard accounting rules, JAP, require companies to amortize that accounting goodwill, right? Write it down over time.
They do, yes. And Buffett sees this as really distorting economic reality. He uses See's Candy as the classic example. See's has tremendous economic goodwill, built up over decades. Its brand, its quality, that economic goodwill isn't shrinking. If anything, it's growing. It's the source of its fantastic profitability.
But the accounting makes it look like it's shrinking.
Exactly. Accounting rules require that the accounting goodwill recorded when Berkshire bought See's gets amortized, written down, which reduces reported earnings year after year. Even as the business's true economic value and earning power are likely increasing, the accounting treatment just doesn't match the economic truth.
Fascinating. Okay, another crucial concept for understanding the real cash a business generates is owner earnings.
Yes. This might be one of his most important contributions, really.
Yeah.
Buffett defines owner earnings as reported net income, plus depreciation and amortization, because those are non-cash charges, minus the estimated amount of capital expenditures the business absolutely has to spend each year just to maintain its competitive position and its current volume of business.
Okay, why is that last part, subtracting the necessary capital spending, so critical?
Because standard cash flow figures that you often see can be really misleading. A company might report high operating cash flow, but if it's achieving that by, say, skimping on necessary maintenance spending, the money needed just to keep the existing machinery running and the business competitive at its current level, then that reported cash flow isn't truly available to the owners without eventually hurting the business.
Got it.
Owner earnings gives you a much more realistic picture of the cash flow that could actually be taken out by owners or reinvested for genuine growth, not just staying afloat.
And bringing this all together, how does he relate intrinsic value, book value, and market price? We touched on this, but just to be clear.
Sure. Intrinsic value, as we said, that's the main thing. It's the discounted value of all the cash flow, the owner earnings, really, that a business is expected to generate over its remaining life. It's what the business is fundamentally worth.
And book value.
Book value is just an accounting number. Historical cost of assets minus liabilities. For many businesses today, especially ones built on brands or services or software, book value often has very little connection to their true economic value or earning power.
He used an analogy for this, didn't he? Something about education.
Yes, that's right. He compared it to education.
The cost of your education, that's like book value, has basically no bearing on the actual value you get from that education over your lifetime. That's the intrinsic value.
Okay.
Similarly, a business's historical cost or its accounting book value doesn't determine its future earning power or its intrinsic value. And the market price, well, that's just Mr. Market again with his daily, often irrational expo.
Which can be way off intrinsic value in the short term.
Exactly, wildly off. But the theory is, over the long run, price tends to gravitate towards intrinsic value.
Okay. Shifting gears just a little bit, the essays also touch on some specific financial topics and Berkshire's own capital allocation choices. They do, yeah. For instance, the sources mention the debate around who really bears the burden of corporate taxes. Just reporting impartially on the arguments is it consumers through higher prices, workers through lower wages, or shareholders through lower returns. It's complex.
And they revisit things like preferred stock and junk bonds experiences.
Briefly, yes, but mostly to reinforce that core theme.
Yeah.
No matter the financial instrument, you need careful analysis.
Hmm.
Look at the specific terms, the risks, the underlying business economics. Don't just rely on labels like junk or high yields. Do the work.
And that philosophy about stock splits and trading activity comes up again, too.
Yeah, it's very consistent. Avoiding stock splits, discouraging excessive trading. It's all part of that deliberate choice to cultivate a specific kind of shareholder base, long-term, owner-oriented. They want the stock price to reflect business value, not just be driven by short-term trading fads.
This connects to why they created the Class B shares, the baby Berkshires, back in the
Right.
90s, right?
Yes, exactly. That was a strategic move. It made ownership accessible to smaller investors who wanted, a slice of the pie. But without doing a full stock split, that might have changed the shareholder culture or diluted the voting power associated with the original Class A shares.
Okay, wow. Let's try and bring this all together. We've definitely unpacked a huge amount of wisdom here.
We really have. I mean, the core lessons seem pretty clear, don't they? Adopt that owner's mindset. Focus relentlessly on increasing long-term intrinsic business value. Learn to look past the standard accounting numbers to see the real business economics underneath.
Right.
Be incredibly disciplined and rational in how you allocate capital, whether that's reinvesting in the business, making acquisitions, or buying back shares. And maybe most importantly, just learn to tune out the daily noise and the emotional swings of Mr. Market.
These principles, drawn from decades of actual experience and presented in Buffett's famously clear, plain language,
Yeah.
they really offer a surprisingly powerful framework for anyone in business or investing. It cuts through so much jargon and complexity.
Yeah, it really focuses on timeless fundamentals. It gives you a kind of roadmap for making rational decisions in a world that's often just saturated with information overload and intense pressure for quick, short-term results. It's just a fundamentally different way of looking at businesses and markets.
So here's a final thought for you to chew on. In a world that often seems driven by complexity, by algorithms, by fleeting trends, could simplifying your approach, could focusing on these timeless, almost common sense principles, could that actually be the most sophisticated strategy you could possibly adopt?